Today, beware, data is not neutral. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. So in our weekly market update, we look at the latest moves, first in the US, go across to Europe and Asia and end up in Australia. But any incoming data requires interpretation to make sense, and the truth is factors like recency bias, expectations and hopium can all influence how news is interpreted and decisions made. We saw this on Friday when US markets read the data as signs of a slowing economy and immediately went to the Fed easing rate rises, despite earlier news that they are keeping at the rate rise rating until inflation is crimped. Treasury yields fell sharply as investors continue to price in the step down in the pace of rate hikes at the Fed's meeting next month. But I think the central bank will need to see further slowing of price increases in the December inflation report due out next week before deciding whether to slow its next rate hike. It raised rates 50 basis points in December, of course, and future earnings expectations are likely overdone for now, so perhaps markets were one-sided in their interpretation of the data. The minutes of the Fed's December meeting released this week was unanimous among members of the FOMC group that they're going to keep interest rates high all year long. Well, we'll see. The jobs report released by the US Bureau of Labour Statistics depicted a still growing labour market, constrained by the far below trend growth in the labour force and putting massive upward pressures on wages as employers have struggled to hire and retain workers. People who either have jobs or who are active looking for jobs jumped by around 439,000, more than reversing the decline the prior month to a record 165 million. Though a record, it remains woefully below the pre-pandemic trend. The number of unemployed and looking for jobs fell to 5.72 million, about level with the pre-pandemic low, but average hourly earnings of production and non-supervisory employees, engineers, teachers, bartenders, technicians, drivers, retail workers, etc., who do not manage other people, rose by just 0.2% in December from November. That's the smallest increase in 2 years and now is in the middle of the range of the years before the pandemic. As a result, Wall Street's main indices all gained more than 2% on Friday after those payrolls expanded more than expected, even as wage increases slowed and services activity contracted, easing worries among some about the Federal Reserve's interest rate hiking path. Non-farm payrolls rose by 223,000 jobs in December, the Labour Department showed, while a 0.3% rise in average earnings across the board was smaller than expected and less than the previous month's 0.4%. In another set of data, US services activity declined for the first time in more than 2.5 years in December as demand weakened with more signs of inflation easing. We got good news on the inflation front with wage gains that are slowing. We got participation rates picking up again, and yet we're still creating jobs. It's a kind of win-win for the economy. And on the other side, the ISM services report was really weak and broadly weak, said Megan Horman, Chief Investment Officer at Verdant's Capital Management. That's basically making people think the Fed is nearing the end of what's been one of the most aggressive tightening cycles we've seen in decades. That's why the markets are taking off. Dow Jones Industrial Average rose 2.13% to 33,630. The S&P 500 gained 2.28% to 3,895, and the Nasdaq Composite added 2.56% to 10,569. This rally boosted the benchmark S&P and the Nasdaq enough to snap 4 days of declines for the holiday-shortened, light-volumed week. The S&P 500 rose 1.45%, while the Nasdaq added 0.98%, and the Dow advanced by 1.46%. For the gains, John Augustin, Chief Investment Officer at Huntington National Bank, pointed to a calm of anxiety that the Fed would raise rates so much that it would cause a recession. Today's report may alleviate that pressure to force a recession. They may already have slowed down the economy enough. They just need validation from inflation reports. Still, the Fed last month projected an interest rate target of around 5% at peak and said it would keep rates high until inflation is where it wants it to be. Fed officials on Friday, in fact, acknowledged cooling wage growth and other signs of a gradually slowing economy, with Atlanta President Raphael Bostic hinting at the chance of a 0.25 percentage point hike at the next policy meeting. But Huntington's Augustine said the central bank needs to see further slowing of price increases in the December inflation report due out next Thursday before deciding whether to slow its next rate hike. It raised rates 50 basis points, of course, in December. And also next week, several of the biggest US banks, including JP Morgan and Bank of America, will kick off the fourth quarter earnings season on Friday. That's the part of the puzzle people haven't been able to figure out. How much should earnings estimates be cut for the calendar year, or have they been cut enough? Said Horniman at Verdant's. All of the major 500 indices gained, with materials up 3.44%. They led the pack. Interest rate sensitive technology was next at 2.99% up. The weakest sector was healthcare, which rose only 0.89%, followed by energies 1.69%. Consumer staples was boosted by Costco, whose shares jumped 7% after the membership-only retailer reported strong December sales growth, and shares in Biogen closed up 2.8% after the US Food and Drug Administration on Friday approved an Alzheimer's drug developed by Elicico and Biogen for patients in the earliest stages of the disease. EISA's US shares closed up 4% at 64.20, and Pfizer shares advanced 2.5% after reports of talks with China to secure a license that will allow domestic drug makers to manufacture and distribute a generic version of the US company's COVID-19 antiviral drug in China. And Bed Bath & Beyond tumbled 22% after Reuters reported that the home goods retailer was preparing to seek bankruptcy protection in coming weeks, so not all good news. Sentiment on a less hawkish Fed was also supported by data pointing to weakness in the economy following that unexpected contraction in services activity. The ISM non-manufacturing data for December fell to 40.6, missing expectations of 55. A reading below 50 indicates contraction. Apple rose more than 3% to move higher in big tech, followed by Meta, Alphabet, and Microsoft. Tesla, meanwhile, closed 2% higher following a rebound from $101.82. That was a fresh 52-week low, as dip buyers emerged even as demand worries intensified after the electric vehicle maker cut prices on its EVs for the second time in 3 months. The price cut that we're seeing in China is a demand story, but I do believe that at $100 a share, we're getting to a point where Tesla is starting to get to a massive risk-reward level to own, despite going into the fourth quarter, where clearly they're going to see lower guidance. Wedbush analyst Dan Ives said in a recent interview. I think that's really the fear. Now, so far as oil is concerned, the US jobs growth for December could not help oil prices sustain a rally on Friday, with crude markets posting their biggest weekly loss in a month after one of the worst trading starts for the year. New York traded West Texas Intermediate crude settled up 0.1% at 73.77 per barrel on the day, after rallying to a high of 75.45 earlier. For the week, WTI, as the US crude benchmark is known, was down 8%, posting its largest weekly drop since the week ended December the 2nd. The dismal week showing came after WTI's drop of 10% between Tuesday and Wednesday. That's the worst of any first 2 days of a trading year in oil since 1991. And London traded Brent crude settled down 12 cents or 0.2% to 78.57 per barrel. The global crude benchmark reached as high as $80.56 earlier on Friday, but for the week, Brent was down almost 9%. The crude price collapse in the first 2 days of 2023 came on the back of fresh warnings about a global recession and on fears of China falling into a coronavirus crisis similar to the one experienced 3 years ago. Oil's progress in the coming week will be contingent on how tame or otherwise inflation continues to be, as markets await the release of the CPI data next week for December. The CPI expanded by 7.1% during the year to November, after hitting a 4-decade high of 9.1% during the 12 months to June. The drop in inflation came after relentless rate hikes last year by the Federal Reserve, which of course have added 425 basis points to rates between March and December. Prior to that, rates peaked at just 25 basis points as the central bank slashed them to near zero after the global COVID-19 outbreak in 2020. But despite its aggressive monetary tightening, inflation remains more than 3 times higher than the 2% per annum level preferred by the Fed, which has vowed to bring price pressures back to its target. Notwithstanding the CPI number, the biggest concern for the oil market could be China's progress on the COVID front. The primary focus, however, remains on China, as energy traders will keep a close eye on the handling of this COVID surge, said Ed Moyer. Since the Saudis are already slashing prices, we could hear a steady chorus of demand destruction concerns if China's COVID situation worsens. Saudi Arabia's Aramco oil company this week slashed the selling price of its benchmark Arab Light crude to the lowest level since November 2021 as it attempts to compete with the persistent discounting on Russian oil after the G7 price cap of $60 per barrel on all seaborne Russian crude. Now, so far as gas is concerned, 3 weeks and counting, and natural gas is still tumbling. America's premier heating fuel fell 17% on the week, and for a third straight week that eased more than 50% in total from the market's value. Gas futures benchmark February contracts in New York settled at $3.71 per metric million British thermal units on Friday, down 10 cents or 2.6%. For the week, the market was off 76.50 cents or 17.1%. to be precise. The tumble came as market participants looked beyond the weekly draw in US gas inventories reported by the Energy Information Administration, or EIA, to focus on more unseasonably warm weather for this winter. Remarkably, prices are now sitting at a year-over-year decline, which is an impressive change in sentiment in such a condensed period, given that the front-month futures were up over 50% just 1 month ago and up over 100% in the early fall, Houston-based energy trading consultancy Gieber and Associates said in its daily note on natural gas. Going forth, gas prices would only rise if weather forecasts indicated colder temperatures in the coming weeks, the consultancy said. Looking ahead to the next gas storage data report for the week ending January the 6th, preliminary market estimates are hugely varied and are calling for a bearish storage report featuring a storage draw ranging from as little as 10 billion cubic feet to as much as 50 billion cubic feet, they said. Presently, there is little solid evidence of true Arctic air entering the picture for at least the next couple of weeks. As such, the gas-weighted degree days for January 6th to the 19th are the fewest for the period in the past 5 years. Notwithstanding the unseasonably warm weather now, gas was both technically and fundamentally oversold. It said prices are prone to rebound once solidly bullish weather news emerges. Until that supportive news materialises, gas market bears are firmly planted in the driver's seat. European gas prices were also lower thanks to the unseasonably warm weather there as well. But of course, while there are still significantly lower prices there, they're still significantly higher than a couple of years back. So it's all relative. Now over in Europe, DAX in Germany, CAC 40 in France, and the FTSE climbed just a little. The main European stock indices received a boost earlier this week from a bigger than expected drop in the speed of German consumer price rises, raising hopes that the European Central Bank could rein in its aggressive interest rate hikes reasonably quickly. This brings, of course, all of the upcoming data on inflation into focus. The December CPI is expected to be coming in around 9.7% on an analysed basis, only a little reduction from the 10.1% growth the prior month, but there is a degree of confidence within the market that there could be a positive surprise with a bigger drop. Data released earlier on Friday show that German factory orders, the most forward-looking of the hard data, fell by 5.3% from October as businesses cut back on orders for big-ticket items in particular. And the news from the country's consumer sector was somewhat better as retail sales volumes rose by 1.1% in November, a little more than expected after a long-awaited government package aimed at cushioning the blow of surging oil prices led households to relax just a little. Even so, sales were still down 5.9% adjusted for inflation from a year earlier. And in the corporate sector, Sodexo stocks fell 3.5% after the French catering and food services group confirmed its guidance for the year 2023, even as it beat expectations for its first quarter sales. And Shell stocks rose 1.3% after the energy giant said it would take a $2 billion tax hit in the fourth quarter as its integrated gas trading soared. Now, across Asia, most Asian stock markets rose on Friday as markets bet on an economic boost from China's reopening of its borders this week, although gains were limited amid caution over the release of those closely watched US non-farm payrolls. China's composite index rose a little as the country prepares to open its borders after 3 years of COVID-19 lockdowns and was up more than 2% over the week. Hong Kong's Hang Seng Index fell 0.4%, but was the best performer in Asia this week, with more than 6% surges after China said it will reopen its border with the Asian financial hub starting from January the 8th. While the reopening in China is expected to eventually spur an economic recovery, the country is still grappling with a massive spike in COVID-19 cases in the near term, which analysts say could delay a broader reopening and could still disrupt business activity. But this notion has hardly dissuaded traders from piling into Chinese stocks, which logged stellar gains towards the end of 2022 amid a surge in bargain hunting. Stock markets, which are heavily exposed to China, also gained on Friday. The Taiwan weighted index added 0.7%, while the ASX was up as well. South Korea's Kospi added 0.7%, with Samsung Electronics, the country's biggest firm, rising more than 1%, even after it signalled that its fourth quarter profit tumbled about 69%. The firm, along with most other major chip makers, is struggling to cope with a massive downturn in the electronics industry as weakening economic growth dried up demand across the globe. Chinese investors are doubling down on economic recovery bets, with a flurry of new funds launched this week on optimism about an end to COVID restrictions. Their money managers warn the next wave of market gains will be less broad-based. More than 30 mutual funds launched this week, mostly equity-focused, offering vehicles for recovery bets. Last month's sector-specific exchange-traded funds drew more than 2.5 billion yuan, or $364 million, in net inflows, according to Sinolink Securities, as investors sought exposures to tech, new energy and defence. But with tourism and hotel catering shares gaining more than 20% since November, and mainland China development stocks nearly doubling since the end of October, some say the trade is now feeling too crowded. Travel and leisure stocks have already priced in a quite optimistic recovery and become pretty crowded trades. We need to be careful here, said Q Wang, CEO of Megatrust Investments, who cautioned the road ahead might be bumpy. These days, home buyers lack the confidence and the price optimism to pull the trigger. We are wary of the continuing weakness in real estate and the negative impact on the Chinese economy. Wang said advanced manufacturing is his top focus this year, and he's also positive about healthcare and internet stocks, where regulatory risks seem to be receding. Another manager at Half4 Fund Management said he'd boosted exposure to tourism stocks over the past few months, betting on a reversal of bad fortunes, but thinks the game is now entering a new phase. We expect performance divergence in the sector, and we will pay more attention to companies' fundamentals going forward. Surging infections and even anecdotal reports of strains on health systems and crematoriums are yet to derail optimism that recovery lies ahead. Eventually, for US investors, the earlier we see infection peak, the better, said fund manager Qihong Asset Management, who expects many places in China to witness peak infections before the Chinese New Year festival in late January. And Yang Delong, chief economist at First Seafront Fund Management, expects China's economic growth to exceed 5% this year as COVID curbs are scrapped. That compares with consensus expectations for about 3% growth in 2022. But as firms price along with hopes, it also means fewer opportunities in obvious places amid a fragile global outlook. Kao Ludi, fund manager at Full Goal Fund Management, predicts an N-shaped economic recovery as an expected spring revival in activity will likely succumb to a harsh reality check in the second quarter. She advised against chasing the high-flying real estate and tourism stocks as their fundamentals remain a question mark. Risks abound in the property sector, which accounts for a quarter of the economy and was badly hit last year as cash-squeezed developers were unable to finish apartment construction. Economists expect price falls can moderate this year as authorities pledge support, but declines remain forecast. Still, the tide of change is lifting all boats, and as global markets falter, it's luring back foreign investors who had mostly been cutting exposure during 2022, especially to sectors exposed to China's consumers. Investors should bet on the reopening trade, and with the obvious liquid consumption proxies, the internet stocks, said Christopher Wood, global head of equities strategist at Jefferies. The virus will likely run through the population quicker than anybody can imagine. This should mean economic recovery by the second quarter, if not earlier. Now, miners lifted Australian shares on Friday, with the index ending the week 1% higher in a strong 2023 start. Material stocks led gains, with BHP firming 3.2% to 47.51 and Rio Tinto advancing 2.4% to 119.63. Fortescue Metals jumped 3.7% to 21.81. The ASX 200 rose 0.7% or 46 points to 7,109, and the All Ords added 0.7% to 7,308. Shares in Magellan Financial Group dive 10.5% to $8.68 in another shocking day after the fund manager reported another tough month in December with $2.6 billion of net outflows. Warrego Energy slipped 1.3% to 37.5 cents amid an intense takeover battle. Strike Energy said its bid represents a 4.2% premium to Hancock's sweetened 36 cents a share bid. Hancock is trying to knock Strike out of the race for Rungo and perhaps head off another bidder. Mineral Resources from entering the race. Mineral Resources leapt 6.9% to $83.54. Gold stocks rose, with Newcrest Mining gaining 2.6%, St Barbara extending gains to be up 2.2%, and Evolution Mining advancing 1.8%. Silver Lake Resources added 2.6%, and Northern Star added 1.2%. The price of the precious metal was on track for a third straight weekly gain. It climbed to a 6-month high on Wednesday on aggressive buying in Asia and Europe. The price of gold stood at around $1,840, holding on gains even as minutes of the Federal Reserve December meeting showed the central bank intended to further raise its policy rate to wrestle inflation towards its 2% goal. High rates tend to weigh on non-yielding gold, so we'll see whether in fact gold can progress or not. The precious metals price has risen too much, too fast, said Halima Croft, RBC head of global commodity strategy. Gold prices may have arrived too early at prices that look more justified later in the year and then into next year. Morningstar believes the best share value is in energy, real estate, financial services and telecommunications. Despite rallying strongly in 2022, many stocks in the energy sector remain attractive, a testament to how cheap they were in 2021, said Peter Warnes, head of equities research for Australia and New Zealand. Whitehaven Coal bounced 1.7% to $9.13 and Santos rallied 1.7% to $7.02. Woodside added 2.1% to $34.63. But the major banks all slipped, falling between 0.1 and 0.6%. And finally, in crypto, Bitcoin is still knocking around the $17,000, and there is little chance of any significant upswing anytime soon. This is because the crypto market needs the realm of easy money to return to build a substantial bull run. However, based on the Fed's current plan, those conditions look far away into the future. Only a black swan event that forces the US government to resort to quantitative easing with low interest rates and economic stimulus like it did during the COVID-19 pandemic could ignite another bull run. According to independent market analyst Ben Lilly, a bubble might be forming in the consumer loan sector, which has grown exponentially in the past decade to nearly $1 trillion. The rise was particularly steep in the last 2 years since the US government stopped writing stimulus checks. Lilly infers that the sector could collapse if many borrowers default on their loans due to growing economic strain. And he also noted that it'll take government stimulus to solve. The timeline for a bubble burst is one of the most challenging things to predict. It could possibly coincide with the recession's end sometime in late 23 or 24. Still, until the confirmation of a Fed pivot or quantitative easing comes along, most investors expect the crypto markets to remain in the downtrend. And to date, the total crypto market capitalization has declined by about 75% from its peak of $3 trillion. The 2017 peak of around $750 billion is a crucial support and resistance level for the market. If this level breaks, the industry's total market capitalization could slip below $500 billion. While there could be temporary bear market rallies, the macroeconomic pressures are likely to undermine all positive moves. So, standing back, you can see here that things are still very volatile, and whilst markets are trying to talk themselves up, the fact is there's still significant headwinds. Interest rates probably will go higher, and there's still a lot of shaky issues out there in the market. So be cautious and careful at the moment, and don't get swept up with the New Year enthusiasm. Remember that many financial analysts and commentators have targets that are reset on the 1st of January. So of course, they're going to be talking things up very hard over the next couple of months. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.